Hi, this is Joe Rabel with Invest Like a Pro. Wanted to follow up on the S&P and give a little bit of a background on where I think the market is right now and what to expect. Some of the things that have taken place as well. Let's start with the monthly chart I have on the left side here. I've got the weekly on the right, but let's start with the monthly. Always start with the higher time frame. One of the things that we talked about the last time is that we're sort of expecting a move, an undercut of the low from 2018, which we saw, and it actually overshot the 38% retracement of the entire bull market as well. I thought, maybe if it broke this low and it didn't hold the 38% retracement, it might come all the way down to the 50% or maybe even this support level of 2100, but it didn't quite make it. In fact, I would still consider this sort of like an undercut and rally pattern off of this bottom right here. So, the idea behind this is we're looking for high probability areas, high probability turning points. And when you have this much volatility, it's not going to be an exact point. There's always going to be overruns on both sides. So now that we've undercut and had a very strong rally off this low, I would consider the area underneath this 38% retracement to be pretty strong support. If we happen to get some kind of a rally and come back down, I would think this would be a very key area to watch. The other thing I would mention to you is notice the size of the tail on the monthly candle from last month. That's a pretty big tail. That is a sign of support down there. So when you get that kind of a push, again, somewhere in this 2200 to 2300 area, I would consider to be support coming back down. Let's look at what, the last time we talked, I had drawn the fib levels for the decline, for the bull market and what the decline support levels would be. Let's look at the weekly chart. And what I want you to do is to actually draw a fib grid starting from the lows and go all the way up to the highs. And now on a weekly chart, we want to look at the 38% retracement on the way back up and the 50% retracement on the way back up. That's kind of the key now, I think, to watch. If you notice, we got right up towards the 38% retracement, and it sort of struggled a little bit. And now today, it pushed through this area. So I think that is a fairly important sign and maybe increases the odds that we're going to go and check out, this next key area up around the 2800 area, which is the 50% retracement. Could be 2750, maybe 2850. If we zoom in a little bit to get a little bit more history, we can see there was a lot of congestion in this area. Dating back. So there's a lot of turning points right in this zone. Any area that acts as a point of support or resistance, if you can find a level, and I've mentioned in other videos, that support and resistance is not an exact point. It's an area or a zone. So I'm sort of looking at this zone 2750 to 2850, but price, action, volume, and momentum are a lot more important to me. How you approach this level up here is going to be a lot more important to me than the exact level itself. For the same reason that we said that on the way down, we're looking for a turning point. And what I'm going to do, I'm going to go down and show you on an hourly chart. Let me take this off. On an hourly chart, we actually came down and broke the downtrend line, which was a very, very strong, let me make this a little bigger. Very, very strong downtrend line. It was tested several times along the way. If I make it a little bit tighter, look at this. Touch here, touch here, touch here. Once you broke that, it was a very strong sign that the market was trying to turn. Notice what's taken place since that time. We had a strong move. We came back and tested this area on an hourly chart. That's about a 50% retracement. Let's just see if that's the numbers if that's right or not. It came in between the 38% retracement and the 50% retracement. I would view that as a good enough test. And then we've come back and taken out the high. So this qualifies as a 1, 2, 3 change in trend on the hourly chart. Now, I realize that, we're dealing with a tremendous amount of volatility. In 1 day, 2 days, 3 days, we could work our way up to 2850, 2750 or something like that and start to turn back down. So don't fall in love with these trends. You got to know where you are and start with the higher time frame. Look where resistance points are. I'm going to take all the grids off right now because I want to show you. I'm going to move this to a weekly and this to a daily. One thing that I think is incredibly unique about this period right now is that we've had a bear market to the downside, a clear bear market, not just barely made 20%. I mean, we cleared it by a pretty large margin, and still the 18-week is above the 40-week. I don't think I've ever seen that. I certainly haven't seen it in my career. I'll have to go back and look at the 29 decline and see if that took place. This is probably similar to that in terms of this initial phase down. But again, the 18's above the 40 still, and there's a lot of room between here and there. I mean, the initial move off the bottom rallied, and it had a lot of room up to the 18-day, and it made it up to that point, and that's where it started to pull back. So the next target area, I mean, potentially is these are going to come down, and this is going to work its way up. I would think somewhere in the 2,800 area, something like that. One of the things that I would probably look at is the 40-day moving average is acting as resistance, and that's a pretty good target, I think, for this next move up. The other thing I'd like to mention is the fact that the MACD lines turned up. And one thing that I want you to be on the lookout for individual stocks, when a market, any kind of market in any time frame, makes a move up to the 18-day and then starts to pull back like this and form a little bit of like a bull flag. I mean, I know it had a gap in it and everything, but you could almost argue it was sort of a pullback along the 18-day. And yet, while that was taking place, the MACD lines were going in the opposite direction. That's usually a really bullish sign from a short-term trading standpoint. Be on the lookout for that. It's really usually, again, something that can be used as a backdrop for positive price characteristics. Again, we had a gap to the downside, and then we had a gap to the upside. These aren't the greatest swing trading type. This is not really great from a swing trading standpoint environment. You just have to be aware of that. It's just the conditions aren't primo for that type of thing. I mean, maybe if you're playing options or anything, but if you look at what happened, we went in the zone and then came out of the zone and then moved up. The only problem was, instead of it just moving up and giving us an entry point, it gapped up through and really made, a pretty substantial move, which really hurt the risk reward on any kind of upside trade. But we know that right now the bias is to the upside, and we have room up to, I would say, right around the 2,800 area. So just kind of be on the lookout for that. That'll be a key area to watch on the way back up. And if it doesn't act as resistance at all, we might be wanting to spend more time in this consolidation to the upside and let the 18-week sort of work its way down. And if that takes place, then we could end up in a sideways consolidation pattern and, maybe just spend more time working sideways as opposed to making a huge move to the upside or a huge move to the downside. Expect the volatility to continue for now. But we could end up in kind of a sideways range as opposed to some really strong directional move in one way or the other. So anyway, I thought this was worthwhile just to give you a little bit of an update on the S&P. Please hit the subscribe button if you'd like to see more videos from Invest Like a Pro, and we'll talk to you soon.